The most popular videos on this channel are all about how to buy second homes and investment properties. These are two of the most powerful ways to build wealth through real estate, but they're also some of the most misunderstood. In this video, you'll find my most watched videos on second homes and investment properties combined into one easy to access masterclass. So you can get the insights, the strategies, and the answers you need all in one place. Whether you're thinking about buying a vacation home, generating rental income, or expanding your real estate portfolio, this video will walk you through what you need to know and what lenders are looking for and how to position yourself for success. Let's jump right in. Have you ever thought about buying a second home or a vacation home? If you have, then this video is for you. Today we're talking about getting a mortgage for a second home, and I'm even going to do a deep dive into some of the numbers. If you came to me and said, Kelly, I want to get a second home and I need a mortgage, the first thing I would ask you is this a vacation home? Is this going to be an investment property? Because how the loan is classified is going to be crucial and important to the overall strategy of the home loan. If the home is truly going to be a vacation home, then the loan can be structured as a secondary home and or a vacation home. It's kind of one and the same from a lending classification. Now, sometimes I will talk to people and they'll say, well, I don't have a primary residence. So maybe they live out of state and they don't necessarily actually own a home in that state. Maybe they're renting. From a lending standpoint, we're still calling this a secondary residence in the sense that it's not the borrower's primary residence. So secondary residence, second home, vacation home, it's all the same type of classification from a lending standpoint. When you're purchasing a second home, you can do as low as 10% down on a conventional loan. So with 10% down, that means you are going to be paying mortgage insurance, but that is the lowest down payment with regard on a second home. The key with a second home, and this is where it starts to get gray. I have so many people, especially here in Arizona, that live all across the nation, and they want to purchase a home here in Arizona, and maybe they're going to come, 30, 60, 90, 120 days out of the whole year. And the other parts of the year, when they're not actually here vacationing or visiting Arizona, they want to be able to rent the home out. This is really important. The second home rider, which means it's actually a document that's in your closing packet of all of the loan documents you're going to sign. It's going to specifically tell you what you can do with this home and what you're committing to by signing the form. And this is important because if you have different intentions that aren't in line with what you're going to sign on the second home rider, then you want to be sure you're talking to your mortgage lender so the strategy, the correct classification can be done up front. We don't want any surprises at the close of escrow. So here's what the actual second home rider says with regard to your obligation. Borrower will occupy and use the property as borrower's second home. Borrower will maintain exclusive control over the occupancy of the property. That's key, including short-term rentals, and will not subject the property to any time-sharing or other shared ownership arrangement or to any rental pool or agreement that requires the borrower either to rent the property or give a management firm or any other person or entity any control over the occupancy or use of the property. Borrower will keep the property available primarily as a residence for borrower's personal use and enjoyment for at least 1 year after the date of this second home rider. So what that's really saying is that can you do Airbnb if you're purchasing a second home and you're using a second home loan property classification? It's telling you that you can, but you have to retain control over the property. So you can't turn around and rent it into some type of management company or have a management company rent it. You can do short-term Airbnb type of stuff, but you can't put a long-term tenant in the property. That's essentially what this is saying. So if that works for your purpose and you absolutely are good with coming out and visiting and staying in the home as a vacation home, and then when you're not here, you're doing some short-term rentals, that's fine. But know that this is what the rider says, and this is what you're going to sign at close of escrow. Now, if that is not your intent, and you are saying, well, at some point in the future, I might use that home either as a primary residence or a second home, but initially my intent will be to put a long-term tenant in the property, then that would be an investment property classification, which means that the lending criteria and the lending strategy is completely different. So an investment property will allow you to essentially rent it out. So you can put a long-term tenant in the property, and from a down payment and an interest rate standpoint, the terms are different. So it is important to kind of know that each classification from a lending standpoint is going to drive the terms of the loan and what you're allowed to do with the property. So getting clarification around this upfront and having these conversations, in my opinion, at the very beginning, making sure that you're crystal clear in what your intent is so your loan officer can help give you guidance on the right strategy so there are no surprises as you move through the home loan process. So this particular total cost analysis is actually showing two different things. We're showing a 10% down second home as a single family residence, a 10% down second home condominium property classification, as well as a 20% down investment property single family residence and a 20% down investment property condo. The reason that I'm showing the difference in the dwelling type is that condominiums have a whole different lending approach. So many times we will see higher interest rates on condominiums, not a lot, but they are slightly higher. So we do want to show the higher interest rate and or cost that may be associated with the scenario, together with homeowner associations on condominiums. Many times will have upfront dues, so we do try to project that into the total cost analysis out of the gate to give clarity around expected cash to close numbers. So in this scenario, you're going to see that on a $300,000 purchase price, if the property is being purchased as a second home, no matter whether it's a single family residence or a condominium, the borrower can put as low as 10% down. But once we move over to an investment property, you can actually do as low as 15% down on investment properties, but that mortgage insurance gets pretty expensive. So in most cases, investors that are purchasing real estate as investment properties are generally putting 25% or more down. So in this scenario, we're showing the 20% down. You're going to see the difference in interest rate. And this is really key. I mean, it's almost a point to a 0.375 higher, depending on the scenario and the day, between a second home property classification as well as a investment property classification. So that's how it pans out. This scenario is also going to show the estimated payment together with the estimated funds to close. So depending on the scenario again and what your ultimate goal is, I think having the conversation upfront is critical to your success.
Now you know the basic process of buying a second home, but one of the biggest questions I get is, where do I come up with the down payment? The good news is many homeowners are already sitting on a potential source of funds they may not have considered. In the next lesson, we'll talk about how to use the equity you've built in your current home to help purchase a second home or investment property.
Whether you're looking to expand your real estate portfolio or secure a vacation spot, I'll show you how to make your equity work for you and how you can use the equity you have in your home to buy a second home or investment property. All right, first things first. What the heck do I mean by home equity? Equity is the difference between the current market value of your home and what you still owe on your mortgage if you owe anything. If you have a second mortgage, it's counted in what you owe, and so the difference between the mortgages and the current market value is called equity. Now, a lot of people ask me, well, Kelly, what the heck is appreciation? And appreciation is another term, and what that would solve for is appreciation is the price you paid for the house versus the current market value. So let's say 4 years ago you paid $300,000 for a house, and today that house is worth $500,000. Then the difference in those would be what your home has appreciated over the last few years. Now, that appreciation could add to the amount of equity you have to use as you think about purchasing an investment property or a second home. As you pay down your mortgage, your home value increases and your equity grows as well. We've had a lot of equity growth over the last couple of years. According to Bankrate, the average homeowner has approximately $300,000 in equity. Oh, wow. Why would you want to tap into your equity? Well, using equity allows you to avoid saving for a down payment, so it could mean that you can enter the real estate market faster. That is one reason. Other reasons are if you're going to borrow money, depending on how you're borrowing money or what you're making with your assets in the market, it all comes down to just leveraging. It's important to know that when you have equity, you have an asset, and you want to think about using that asset just like you would using liquid assets or liquidating stocks or maybe having an inheritance, but it is truly an asset, and you want to think through how to best leverage that asset. The question is, how do you access your equity? First, let's back it up. Because so many times we are consulting with home buyers and their thought is to put a large amount of money down. I always ask them, what are your future plans? If your future plans are to purchase an investment property or a second home, consider not putting so much money down on the property that you're purchasing, because here's the deal. You have to pay money to go back in and access your equity. That's an important part here, because when you just think about that, I've had so many conversations over the years. Somebody's selling a house, they're going to pocket $300,000 and they want to put the full $300,000 down on this new home that they're purchasing to live in, but not realizing that maybe it makes more sense to put $200,000 down if their ultimate goal is to go buy a second home and investment property. That way they're not having to do what I'm going to tell you next, which is how to access your equity. All right, let's assume that you have had great appreciation, you've been paying down your mortgage, you've got a nice little nest egg there of equity that you want to consider tapping into to go purchase a second home or an investment property. Here's a few ways you could do that. One, you can look into a home equity line of credit or a home equity loan. Now, these are actually different programs, and here's how they differ. A home equity line of credit is going to be kind of a revolving line of credit. It looks and feels like what you would think about like a credit card, meaning that you have a limit on it, you can borrow on it, you can pay it off, it stays open for a period of time. Now, the interest rates on home equity lines of credit are generally based on the prime rate plus potentially a margin. And so just know that that is how that interest rate looks. And it is a second lien or a second mortgage, as is a home equity loan. Now, home equity lines of credit work well just to get it attached to the property and have it, and it can sit there without you drawing on any money. So from a planning standpoint, it's something to think about if you think at some point in the future you are going to purchase a second home or investment property. Now, there usually is an annual fee on the home equity lines of credit. Generally, they stay open for roughly 10 years, and they all differ, but that's kind of how it looks. Also, it's important to know that most home equity lines of credit bill each month on an interest-only payment, which means that if you just pay the interest without paying anything towards the principal, that balance is not going down. And so just from a planning standpoint, depending on what's going on in your specific situation, you want to consider that. I have a lot of people that we talk to, they're like, gosh, I've got this $25,000 home equity line of credit and it's not going anywhere, meaning that the balance isn't going down. It's not going down because they're not forced to pay a payment, and many times they don't have the discipline or maybe the extra funds to pay the payment. So just kind of know that's the home equity line of credit. Now, let's pop over to the home equity loan. This is something that gets less play out there in social media and from the lending institutions, but it can be a great option, especially if your timetable, meaning that you're ready to pull the trigger, you found a second home, or you know that you're going to be searching for a second home or investment property in the next 60 to 90 days, you may want to look at the home equity loan in addition to the home equity line of credit, because they work a little bit different, and we do have many clients that like to opt for the home equity loan. So here's how that works. Again, it's going to be a second lien, meaning this is going to take second lien position behind your first mortgage of your home. It's going to be right there. And the way that the home equity loans work is they're generally a fixed rate, whereas the home equity line of credit is a variable rate. Home equity loans are a fixed rate generally for a period of time. That could be 10 years, 15, 20 years, potentially even 30 years, depending on the loan amount. So what that's going to do is it's going to allow you to have a principal and interest payment. So now you're paying towards the principal of that. And sometimes it actually has a lower interest rate than the variable rate that you could see on the home equity line of credit. Again, market conditions are going to drive credit score, equity positions. There's a lot of factors that drive the differences in terms on each one of these. But both of these are vehicles for you to be able to access your equity. Now, the third thing I want to make sure that you are aware of is I'm talking about second liens. Again, meaning that you're not touching your first mortgage if you have a first mortgage. But let's say that you do have a first mortgage. Let's say that it maybe has a higher interest rate. Let's call it higher than 6%. Maybe you have built up a large nest egg of equity. And maybe, depending on what's going on in your scenario, in addition to being able to access that to buy a second home or investment property, you have other things you also want to do with that money. In those scenarios, potentially a cash out refinance could be something to explore. When we talk with clients through their strategies on how to achieve this type of thing, we're asking them the questions. We're going deep into what's going on with their current first mortgage. Are they paying mortgage insurance? What type of loan is it? Is the mortgage insurance ever going to drop off? Does it make sense to get out of that loan, convert into a different type of loan financing product that would allow them to tap into some of their equity and reposition the overall mortgage debt? Lots goes into this. I know, right? But these are fantastic options to explore if you are in a position that you're sitting on a big nest egg and you would like to tap into some of that equity to make it work for you. Now, let's say you have an investment property that you've had for a period of time and you're going to sell it. You may want to consider doing a 1031 exchange, meaning that you can defer your tax implications from the sale of that home, take that equity, use it to purchase a like property. That could be multifamily, that could be another single family residence, that could be anything that's kind of considered and allowed under the 1031 exchange guidelines. But that's another way to be able to tap into the equity of a property to use to purchase another type of property. At the time of this video, current market conditions, and again, this is going to vary depending on what part of the country you're in, the season, etc. But I'll say just in general, we are still seeing sellers willing to negotiate. Whether that is contribution towards closing costs, whether that is contribution towards paying your real estate agent, whether that is contribution towards bringing down the price, or a variety of all three, we are seeing sellers very willing to participate and help move their property and find that buyer. I say as of this filming because we know market cycles change. As interest rates come down, we are starting to see more demand come back. And at some point when demand is there, sellers are going to be less likely to negotiate. And that's just the reality of it. Even as I say this, we still have certain properties that go on the market that are priced well, that the sellers are not having to contribute any additional extras, and multiple offers goes under contract very quickly. So it's hard to say what kind of market that we have based on when you see this, but know that it's always a good option to just talk with your real estate agent and explore what type of market you're in, especially specifically for that home in that area, and see if there's something that can be negotiated to help you either with closing cost credit or a lower home price, etc. Real estate agents are the ones that have the street knowledge that can help you when negotiating a purchase contract to buy real estate.
Using your home equity can be a powerful strategy, but before you move forward, there's an important decision you need to make. Are you buying a second home or an investment property? While they may sound similar, lenders treat them very differently. In the next lesson, we'll break down exactly what separates these two property types and why it matters.
First and foremost, know that when you go through the home loan pre-qualification process, the lender is going to want to know what your true intent is with the property. And intent is important because it will drive the home loan classification. For example, if your intent is to purchase a home that you're going to vacation in and spend some time in that home during the year, and maybe when you're not vacationing in the home, your intent is to rent it to family or friends, or potentially even on Airbnb or VRBO. If that's your intent, then a second home property classification could be a good fit for you. If your intent is to purchase a property and put a long-term tenant in it and start to build wealth through that real estate, that becomes more of an investment property type of home loan classification. Now you might say, well, what's the difference? There are differences based on the home lending guidelines, two of which are on a second home, you're allowed to put as low as 10% down, whereas on an investment property loan, you have to put a minimum of 15% down, but generally we see investors putting 20, 25, or 30% down. And the reason for that are the terms of the home loans in both scenarios improve with more money down. So if you're an investor and looking to invest on a long-term buy and hold type of strategy, many times we're seeing at least 20% down to avoid mortgage insurance and to get better terms. That 15% down investment property pricing is ugly. So we just don't even see it really come into the conversation. But it is important to know that it exists. Outside of the down payment difference, the second difference is the seller credit. The allowable seller credit is going to vary based on the home lending guidelines between a second home and an investment property. On investment properties, the max is 2% seller credit. Doesn't matter the down payment. When we look at a second home, the seller credit is going to vary based on the down payment and could be anywhere between 3 and 9%. So while we start to think through down payment and potential seller concessions, it used to be that there was a big interest rate or cost difference. But that kind of changed a couple years ago when Fannie Mae and Freddie Mac changed the lending guidelines and changed what we call LLPAs, or loan level pricing adjustments, associated with the second home. So prior to that change, pricing, and by pricing I mean interest rate and cost of the home loan, really was aligned more with primary residences versus investment properties. But since that change, which occurred a couple of years ago, now when we look at interest rate in terms, second homes price more closely to an investment property type of interest rate and term pricing. Now, there are some really cool things happening out there. One of which is we're seeing programs come to market that actually fill the gap, meaning that Fannie Mae and Freddie Mac, which are conventional conforming home loans, because of those loan level pricing adjustments, there isn't much of an incentive for second home property classifications other than what I said, the closing cost credit availability and the down payment. But outside of that, when we get into interest rate and terms, they're more closely aligned. Well, these programs are a solve for that. So if you're working with a lender and going through the process and they don't have alternative home loan programs that can solve for better terms in certain situations, again, it's not just one size fits all, but based on credit score and down payment and property classification, we're seeing that there's this whole new uprising of programs out there that can offer better terms than the traditional Fannie Mae, Freddie Mac second home approach. So if that's you and you want to inquire about the details on these programs, if you're purchasing a second home or an investment property, please click the link below and schedule a 15-minute consultation with the KellyZitlowGroup mortgage advisor. We'll kind of dive deep into the nuances, what your intent is, how you envision holding the property, etc. And then we can start to design a program around those goals. One of the additional differences from a lending standpoint is that if somebody's purchasing an investment property, many of the lending guidelines allow for a certain percentage of the projected rental income to be calculated into the debt to income ratio, whereas back on a second home type of property classification, that is not the case. So when I say there's so many different nuances, there really are, and what's important is to have a detailed conversation about your goals with an educated lending team that truly understands the right questions to ask and that can walk you through a structure that helps you achieve your goals.
Now that you understand the difference between a second home and an investment property, let's look at one of the most popular strategies first-time investors use to get started. In the next lesson, I'll show you how some buyers use FHA financing to purchase an investment property with a much smaller down payment than most people expect.
Whether you're a first-time investor or looking to expand your real estate portfolio, understanding the ins and outs of FHA loans and how they can be used to purchase an investment property can be a game changer. You may have heard that FHA loans can only be used for primary residences, but there is an actual way to purchase an investment property with an FHA loan. Here's how it works to purchase a multi-unit property, which is 2 to 4 units, and live in one of the units as your primary residence and rent the others out. Here's a quick example of how one of our clients actually used this strategy to build wealth. Our clients bought their first home in 2017 using an FHA home loan. It was a 4-unit property and they paid $245,000 for it. Today, it's worth $620,000. Now, they lived there for 2 years before converting that unit into a rental as well. We're actually in the process of pre-qualifying them to purchase another home. And we noted on the tax returns that from that 4-unit dwelling, they have made $53,000 in rental income. Wow. Now, they refinanced to a conventional home loan in 2021 with a 3.9% interest rate, with a mortgage payment of $1,677 per month. Even with expenses, the numbers highlight how profitable this type of investment can be. Now, the beauty of using an FHA home loan to purchase an investment property is this. It offers a very low down payment. Where else can you purchase a home with a 3.5% down payment? And that's because, again, while you're purchasing an investment property, so in this scenario, it was a 4-unit investment property, but it could be a 2-unit. You're going to rent out one and you're going to reside in the other. It could be a triplex. You're going to rent out 2 and reside in one. Or, as in our client situation, they bought a 4-plex. They rented out 3 of the units and they lived in one of the units. The key here is that they're living in one of the units as their primary residence. And that's why this is such a nuance, such a cool program and a cool way to essentially be able to purchase an investment property using an FHA loan and tapping into that very low down payment offering of 3.5%. Now, I get questions all the time about what's the max loan amount. Here's what's also cool about FHA financing. The max loan amount is going to vary depending on the county that you're purchasing the property in. To find out what the maximum loan amount is for each one of these dwelling types, meaning single family residence, duplex, triplex, or a 4-plex, you can go to HUD.gov and you look up the county and it's going to tell you the maximum loan amount that's available. Now, this is cool because in the Phoenix metro area here in Arizona, that maximum for a 4-plex is over $1 million. So from an FHA perspective, the guidelines allow for an increase much higher than what their normal max loan limit is every year based on the dwelling type. And that's the key here. Okay, so now let's talk about what are the costs and fees. Again, another really cool thing about this is it is structured as an FHA loan, which means standard lender fees are going to apply. The only real additional fee is depending on the type of dwelling, there are some additional needs from the appraisal perspective, and that could be a couple $100 more. But outside of that, it is a very cost-effective home loan strategy. Now, if you're interested in purchasing an investment property, you've probably been doing some research and you may have found that on a conventional home loan, investment property interest rates are generally much higher than if the property was going to be occupied as a primary residence. Here's another house hack on this program, and that is, this is an FHA loan. You're going to reside in one of the units, and therefore FHA primary resident interest rates apply here. What? So we just talked about lower than normal down payment allowances for this strategy, no increased cost other than a little bit more expensive on the appraisal side, and primary resident interest rates to purchase an investment property and build wealth. It is unlike any other home loan strategy out there today. One of the benefits of an FHA loan is that they're very user-friendly when it comes to underwriting guidelines. Standard FHA credit guidelines apply on this program, so no different for this type of strategy. And from a debt-to-income ratio standpoint, the rental income can be used into the qualifying process. So cool. FHA lending guidelines allow for credit scores down to 580. Now, if you've been following me at all, you know it's not just about credit score, it's about the credit profile. But the point here in sharing that is that FHA financing allows for life happening, allows for lower credit scores if there's something that's gone on. As long as the credit profile meets the lending criteria and all other factors adhere to the FHA lending guidelines, the credit score is less important on an FHA loan than on a conventional loan in comparison. Now, debt to income ratio, this is kind of cool. If you are purchasing, let's say, a duplex, you're going to be able to use the rental income in your qualifying approach on this FHA loan strategy, which is going to help your debt to income ratio. Lots of cool things that go into this one very unique FHA financing strategy to acquire an investment property. I'm often asked, all right, what's the catch? What do I need to know that I'm not asking? Here's the very important part of what you should know if you are using an FHA loan to purchase an investment property, and that is, be sure you are talking with a lender that understands the strategy, that understands the nuances of the guidelines specific to this type of purchase acquisition, because they are different than a traditional FHA primary residence process. Slightly, I mean, most of the foundation elements are the same, but there are some variations here from a lending process that you're going to want to ensure that you've got the right lender that understands how to get you to the finish line.
Just because you can qualify for a property doesn't necessarily mean you understand the true cost of owning it. In the next lesson, we're going to go beyond the down payment and talk about the real financial differences between buying a second home and buying an investment property.
First and foremost, I just want to thank everybody out there for watching these videos. The story I'm going to share today actually came from somebody that watched a YouTube video that I did on second homes. So here's the deal. I'm going to walk through the numbers because I think the numbers tell the story. This person that reached out saw a video. He was getting ready to purchase a home in Connecticut, and he was looking for a second home. Now, he's a real estate agent, so he already has some kind of intel about second homes versus investment properties. And for his particular situation, he was very focused on the second home property classification. Well, what does that even mean? First, let's chunk it down. From a lending standpoint, you're going to tell the lender what your intention is with the property. So if you're going to live in it, it's going to be considered a primary residence or an owner-occupied type of scenario, which is going to dictate the type of loan, the down payment, the interest rates that you would get. In this case, he was going to use this as a vacation rental. And this is key, which is why that video that he saw actually had him reach out. But in his case, he wanted to do a minimum down payment type of loan. And he was thinking he wanted to do a second home property classification. But he'd already been pre-qualified with another lender. And what I know about second homes that a lot of lenders don't share, including the lender he already spoke with, was that there is a rider that accompanies the deed, the security instrument, the final loan documents that a borrower signs when they purchase a second home. And that rider specifically dictates what you can do with the property. Well, he was not aware of this. And what it says specifically is that it's going to require that the property remain under the owner's control. And so in short-term rental situations, that's not always the case. When you are getting a management company involved, which he wanted to have a management company actually manage the property. And his intention was to use it a couple times a year as a second home. But the majority of the time, he was going to have a management company do short-term rental management for the property. And he was like, his mind is blown because like, what? I've talked to all these different lenders and nobody's mentioned this to me. That's right. Nobody has mentioned to you. And here's the deal. It's not that they're trying to be deceptive in most cases. It's not. It's just awareness, because what I want to make sure that we don't do is lead somebody down this journey and then they're at the closing table and maybe we as the lender misunderstood, or they misunderstood, or maybe we just didn't have a conversation around this. So whenever we have people that are purchasing homes as a second home, we dive in deep up front in that initial conversation so we can help educate and explain that, hey, a second home property classification may not be the best for you because what you're sharing with me, you want to have a property manager manage the second home. So in that case, let's move over to a lower down payment investment property. So here's the math. And I know I get excited, right? But here's the math. So in this scenario, I showed him a 10% down second home. And based on the day that we were pricing this, interest rate was like 7 3/4. Interest rates on second homes and investment property are higher than on primary residences, which would account for the higher rate. If you're sitting here going, a rate in the sevens, yeah, a rate in the sevens, at least based on this point in time. The second scenario, though, is a 15% down investment property, and it's at the same rate. So yes, for another 5% down, it gave him complete flexibility with what to do with the property and when to do it. That same rider doesn't exist on an investment property. So there's no anybody dictating whether it can be a short-term rental, whether he can have a property manager manage the rental, whether it can be a long-term rental. On an investment property, it is open game. As an investor, you can do what you want with the property and however you want it. So his mind was just kind of blown of like, oh my gosh, I didn't even know this existed. And then over in the third column, we showed a 20% down on an investment property, and that's where the interest rate break was. So the goal here is to show you the math to make sure that if you're considering a second home, that you're thinking through what are you going to do with it. And maybe out of the gate, it's really just going to be a second home, and your intention is to maybe do some short-term rentals, but you're going to manage it and stay in control over the property. That's the key. As we move through this, and I just kind of planted the seed on the extra 5% down, doing that 15% down investment property to give him complete flexibility. I was like, winner.
And what's so interesting is many buyers assume second homes are only for vacations or rental income, but that's not always the case. One of the most common scenarios I see involves parents helping a college student or family member with housing. In the next lesson, we'll talk about what lenders allow, what they don't, and how to structure these purchases correctly.
I'm often asked from parents, let's say, that have a child going to college and maybe they live in a different state and they're coming to Arizona. Maybe they're going to go to Arizona State because, go Sun Devils. But anyway, I digress. But back to that, in that case, many times the parents are going to be coming here and using that house as a secondary residence. And maybe the child's also going to be living in that house as, a primary residence. There's so many different strategies and ways to look at this. One of which is if the student can be on the home loan with the parents, it's fantastic. It's a great option because in that scenario, it becomes the student's primary residence, which allows for a lower down payment. And the parents can be non-occupant co-borrowers to help the student qualify. And sometimes if the student, maybe has a limited credit depth, that's okay because the parent's credit would be used to qualify. And let's say the student has no income, that's okay. In that scenario, the parent's income could help the student qualify. So that's one of the strategies that we get into where we have families that are kind of purchasing a house for a particular reason. Now, let's say that you have, a brother out of state and you want to help your brother purchase a house. I think you kind of get into the same type of conversation. Can the brother be on the home loan? Yes or no? We want to rule that out up front because that will help to give the lender some guidance on how to structure it to meet the lending guidelines. And I tell you, it's really important because the lending guidelines have 3 different occupancy classifications for conventional loans. One, a primary residence. That means that is where you are going to live. That is going to be your primary residence. You're going to end up changing all your driver's license and your tax filings and everything else to be that address. That's what you are primarily going to occupy. So from a lending perspective, that's called a primary residence. The second of occupancy classification will be a vacation home or a secondary residence, meaning that you don't necessarily have to own a house to have a secondary residence from a lending perspective, but it would mean that it is not your primary residence. Maybe it's going to be a vacation home. So in that scenario, the lending guidelines have a program built out around it. And in a vacation home type of scenario, I get this question a lot. If you, let's say, are out of state and you're purchasing a home here in beautiful Arizona, where it's sunny most of the year, let's say that there are going to be times where you can't live in the property or you don't want to live in the property and you want to just do Airbnb. The second home rider, meaning that the actual document that you will sign will allow somebody to be able to use Airbnb for the time that they're not occupying the property. Now, the verbiage in that document is very specific, and essentially it says that you must retain control over the property, which means no long-term leases for the first 12 months. So That takes me to my third occupancy type of scenario, and that is a true investment property. So if it is your intent to purchase a piece of real estate and your intent is to put a long-term tenant in there or execute a lease, and you're going to be receiving rental income and you're not going to be occupying that property at any point in the first, let's say, 6 months to a year, then that property is going to be classified as an investment property, which means larger down payments, a little bit higher on the interest rate, but it is absolutely one of those classifications that helps investors purchase real estate and finance it. So those are the occupancy types of classifications. Now, there's a million questions that come about and, well, which one fits my particular scenario? Again, that's where you've got to go back and talk to a lender that can kind of ask the right questions to lead you on a path. Maybe based on what you're saying, it needs to be classified as an investment property. Then if that's the case, then that's the case. At least you'll know out of the gate. I had a call yesterday from a parent who just paid cash for a property, and he wants to do a cash out refinance and now put a lien on the property. He lives here in Scottsdale. The property is in Phoenix, and based on that situation, he is not going to be occupying the property. He does not want his son or daughter on the home loan, and he's going to be renting it to his son and daughter. In that scenario, that would be classified as an investment property because he's going to put a tenant in the property and neither one of the children are going to be on the home loan or the deed of trust. That's how that scenario would play out.
Now, if you're thinking about creating income from real estate, buying for family is just one option. Another strategy that's attracting a lot of attention is short-term rentals. In the next lesson, I'll show you a financing strategy that could allow you to purchase an Airbnb with as little as 10% down.
Well, let me tell you, there is a strategy that does not require 20% down. So here's the scoop. Fannie Mae actually has a loan program that is a conventional loan, and it allows for a 10% down payment on a secondary residence or a vacation home. Many times when I talk to borrowers that want to purchase a second home, they also have this thought that maybe when they're not occupying the property, that they will do some short-term rentals, i.e. Airbnb. In that strategy, a 10% down payment could suffice because that's the minimum down payment for Fannie Mae. Now, there are some rules, and I'll drop in the actual verbiage from the Fannie Mae deed with regard to second homes. But the key here is that, one, you are indicating that this is going to be a secondary residence. You're going to occupy the property for some portion of the year. You will maintain it as your secondary residence for at least 1 year after close of escrow. The other big component here is that you cannot turn over the management of the property to a management firm. So you must retain the ability to manage the property and occupy the property yourself. There's a few other things in there, but again, I'm going to drop it in so you can actually read verbatim what the deed says. Now, let's say that's not the case. You're like, I'm not going to occupy it as my second home, where I've fallen in love with a property that I know is going to cash flow. It's going to be a great investment. What does that look like? In that scenario, your lender would be treating this as a traditional investment property, meaning that you would now be putting 20% or more down. And in that scenario, you can essentially do whatever you want with the property. So that can be short-term Airbnb types of rentals. It could be a long-term tenant. And in that scenario, the cool thing about a traditional investment property strategy from a lending standpoint is projected rental income for average rents in that particular area or subdivision. A percentage of that can be used in your qualifying ratios. So a lot of people don't realize that, but if you are in a scenario that you're wanting to build an investment property portfolio, make sure your lender is remembering that they can use a certain portion of average rent based on the area for more programs. Now, let's say that you are thinking, gosh, I can't qualify like on a traditional type of debt to income ratio or provide the traditional documentation that most home loans require, i.e. W-2s, pay stubs, tax returns, that type of thing. There are programs out there that are called DSCR, and that stands for Debt Service Coverage Ratio. And those programs are completely unique and unlike anything that traditional lending follows because it's really treated more like a commercial loan. So what that program wants to see is what's the payment on the property in relation to what the rental income is, what's that ratio, can that payment cover it? There's certain formulas that program uses, but that's a great strategy where if we can make that work as a viable program for you, then you're not having to provide tax returns and W-2s to qualify for the rental property. So that's really a pull program. And then lastly, bank statement. There are bank statement programs out there for self-employed people. So again, it's just like kind of another angle or approach on how can the lender document income. And very often for self-employed people, that's going to be through either 12 or 24 months bank statements. Those might be personal bank statements. Those might be business bank statements. There are a variety of programs out there. But those programs could also allow you to leverage that type of financing strategy to be able to purchase an investment property. So when we think about Airbnbs in particular, because that's what I'm focused on, all kinds of legislation out there, different regulations based on the cities, this gets a lot of play in the media. It is important to make sure that wherever you're purchasing that home, that you can in fact rent it out and you can do short-term rentals, i.e. for Airbnb, because there are areas or subdivisions or HOAs, if you're purchasing a condo or maybe a townhouse, that do not allow for short-term rentals. So be sure that you're researching that and working with your real estate professional. They're going to be able to help you identify, is this property eligible for short-term rentals, yes or no?
All of this is really exciting, but before you rush out and start shopping for a vacation rental, there's something every buyer needs to understand. The rules surrounding second homes can be surprisingly strict, and violating them can create major problems. In the next lesson, we'll cover the second home rules that lenders don't always explain clearly.
I have received hundreds of questions and comments on my YouTube channel over the year, and I'm actually going to give you real questions with real answers today. So these questions stemmed around a second home investment property video that I did. So let's start with the first one. My primary home is mortgage-free, and I plan on building a second house in another state prior to retiring. My plan is to retire in 2 years, then move to that second house and use my equity to pay it off. What loan would you recommend for the second home? I plan on building the home myself and I already own the land. Okay, our response was, we asked them just to call the office because there is a lot of complexity in this type of question. And sometimes we just can't get it all out. We just need to connect, ask more questions, and then be able to discuss strategy. We had somebody chime in though, and I love this because Sticky Bandit chimed in and said, meaning you don't have an answer because no loans let you do this. And that's not the case. So I wanted to set the story straight that there are different strategies. But it is important to know that rarely in home lending is it a one-size-fits-all answer. So much of the detail that goes into the qualifications, whether that's cash reserves, whether that's income, debt-to-income ratio, etc. And on this particular situation, because he says, I plan on building the home myself, the initial question would be, are you a licensed general contractor? Because if you're not, and that's not your business, it may be difficult to obtain a construction loan. So there are 3 strategies that I would have spoken with this client about had he called. And that is, 1, a construction loan may be an option, but we would definitely need to dive into, when he says he's going to build it himself, what experience does he have? Again, is he a licensed general contractor? Because the construction loans have very stringent guidelines around licensed general contractors. The next option is, depending on how much equity he has in his primary home, he could consider putting a home equity line of credit on his primary home and then just drawing from that line of credit to build the new second home. So that could be strategy number 2. And then strategy number 3, and you can see why having a discussion would be important, is how much does he have in assets? So if he has a very large stock account, let's say, there's another strategy that he could potentially put a margin account on his asset, on his security asset, and then draw from that. It very much works like a home equity line of credit, but not being tied to his primary residence, is actually tied or leaned against his assets. So there's a variety of ways that if he's not a licensed contractor and a construction loan would not necessarily be the conduit or the right strategy for him, it doesn't mean that loans don't exist. It just means that we have to think bigger and really know more of the story to kind of dive into the strategy. So hopefully that helps answer the question to Sticky Bandit and our initial person that asked the question. Next question. I plan on using my current home as a rental unit. I still have a mortgage. I will profit $500 to $700. The next home I get will be my primary residence. Can you please help me understand how that transition will work? Okay, lots of moving pieces here. First of all, awesome. You're building wealth through real estate and you purchased your initial home. Sounds like it's a primary residence. You've probably been in it for a couple of years. Now you're going to retain that residence. You're going to rent it out and you're going to go buy a new primary. So that is the way it's done. Secondly, when we dive into answering this question, the answer is really going to be predicated on the type of loan that you're going to use on the new primary residence. So for example, if you're going to use a conventional loan, then you would need to do the following. One, keep in mind that on a conventional loan, if you don't have any rental history, so you have not ever been a landlord, you haven't owned any property that you've rented out, then the conventional lending guidelines are going to only count 75% of the lease agreement, and you would have to have an average rent schedule to support that lease agreement. So let's kind of walk through it. Let's say that the lease that you receive is $2,000 a month. 75% of that is $1,500. But let's say that your total house payment, principal and interest, taxes and insurance, the whole kit and caboodle is only $1,300 a month. Then you don't get that extra $200 that counts as income into your debt to income ratio on the new loan. That's the point here. Unless, of course, you have rental history. I'm sharing this because there's a lot of confusion and there's a lot of stuff out there on social media that says, yeah, the lender's going to take 75% of the lease agreement and it's going to help you qualify. Well, it's only going to help you qualify without rental history by offsetting your payment, assuming that the numbers work. So hopefully that helps. Now, if the new loan is going to be FHA, then FHA has a whole different set of guidelines. FHA says that first and foremost, the new house has to be 100 miles away from your departing residence. So if that's not the case, then FHA is likely not an option for you with the new primary residence purchase. Secondly, let's assume it is. Let's say you're relocating, you're moving to another state. Now you meet that 100-mile distance. FHA is only going to use 75% of the rental lease agreement to offset your payment. So again, there's no option on FHA to count any difference, even if you had rental history in the past. So hopefully that helps you kind of like understand. I love where you're going. I love the fact that you've done the math. You know that you're going to cash flow, and that is still a reality. It sounds like you still will cash flow based on the numbers you ran, but from a lending standpoint, how the lending guidelines are going to utilize that rental income is going to vary. All right, next question. We just bought our primary residence, but in 5 years, we would like to purchase a vacation home. We are both teachers and don't make a ton of money, but we want to be smart with what we have. What's the best thing we can do now to prepare to purchase another home in 5 years? All right, when we think about vacation financing on a conventional home loan, first and foremost in your head, know that you have to put a minimum of 10% down. And interest rates and costs on conventional loans for second homes will improve the more money you put down. That being said, the first thing you can do over the next 5 years is to start to set money aside to save money for the down payment. That's going to help you get the best terms and be in a position to be able to get that lowest payment, which it sounds like that's going to be important for you. Outside of that, I would say just keep debts at minimum, meaning pay off credit cards every month, be frugal with new car purchases, because credit card payments, car purchases, student loans, all of that goes into the debt to income ratio that's going to be calculated on that new second home. So hopefully that helps. The last question in this series, I'm renting my home, but I forgot to tell my mortgage company. I have been renting it since September 2024. Will I get fined? No. You're not going to get fined. assuming that you met the conditions of the deed when you either last refinanced or you purchased. So that's a piece of this question I don't know. I'm assuming that you resided in the property. If you called it a primary residence, you resided in the property for at minimum 12 months. And if that's the case and it's been a couple of years and you decided to rent it out and either go rent or buy another house, totally fine. Just let the lender know. If you're less than 12 months, this is where it gets sticky because a lot of people don't necessarily read the loan documents or understand the intent that they're signing to. So when you take out a home loan for a primary residence, meaning that this is going to be a property that you're going to live in as your primary residence, the deed that you're signing actually says that it is your intent to occupy that property as your primary residence for 12 months. And where we get into this whole thing called occupancy fraud is when people say that they're going to do that, but then they close on the mortgage and the house gets listed for rent within, weeks or a couple of months from that acquisition, and maybe they never moved into that house, then technically that is mortgage fraud, and that's what we don't want. So I appreciate you asking the question. Hopefully that helps.
By now you understand the rules, but what if your income situation isn't straightforward? Self-employed borrowers often assume buying a second home is out of reach, but that's simply not true. In the next lesson, we'll look at how self-employed buyers can successfully qualify for a second home mortgage.
Let's dive into the things that home loan lenders look at for self-employed borrowers. First and foremost, I do want to challenge this thought that just because you're self-employed means that you cannot obtain home loan financing, and that is just not the case. But there are a different set of rules when you're self-employed that lenders are looking at things a little bit different because it is more complex than if you just receive a straight salary and your W-2 and 100% of your income is coming from that type of source. So I do want to dive into some of these lender requirements, dispel a few myths, and then just ensure that you're thinking about what the lender is going to want and need if you decide to push forward with purchasing that second home. Okay, so tips and tricks. First and foremost, why? Why in the heck is financing for a second home different than a primary residence? Well, it's a second home, so very likely you already own a primary residence. You may already own an investment property. A second home, the intention of that is this becomes a home that you are going to use, whether that's a vacation home or it's a secondary residence that's not classified as your primary. So because of that, second home financing differs from primary residence financing by the terms. So the interest rates are higher on second homes than they are primary residences. So the down payment is more, the loan program availability is different. And really when we kind of think about, okay, all of that's fine. There's no difference between what I just said, whether you're self-employed or whether you're a straight W-2 wage earner. And I do want to add, we have many people that pay themselves a W-2 depending on the organization structure of their company. If you own more than 25% of the company, even though you're paying yourself a W-2, you're still considered self-employed, which means that what I'm about to tell you is relevant. Let's kind of think through what is home loan financing? What type of investment is that? And it really comes down to, it is a risk-based type of lending program. And when I share that with you, I think as entrepreneurs, you're going to understand that. If you are going to give somebody $200,000 out of your pocket, then you would want to be sure that they can pay it back. And at the very basis, at the very foundation of this, that is what risk-based lending is about. And that's what home lending does. That's what all home lenders do. Combine that together with the Dodd-Frank rules that went into effect after the Great Recession. Now there's federal lending requirements that require lenders to document, according to lending guidelines, the ability to repay. So because of this, the nuances for self-employed borrowers may feel a little bit more cumbersome, but we work with a lot of self-employed borrowers, and a lot of it's really going to come down to your tax returns. First, know that if you have been self-employed for less than 5 years, you're going to have to be able to provide to the lender 2 years of filed tax returns. So that's the 2 most recent filed tax returns. Now, depending on the year, or the time of the year that you're wanting to purchase a house, maybe it is early in the year and you haven't filed last year's tax returns, but you want to purchase a house before you're going to file them. Now the documentation is going to be even more. So in that case, it would be the previous 2 years filed federal tax returns, all pages, all schedules, and then you may have to provide a year-to-date P&L for the most recent year that you haven't filed taxes for. And then depending on when in the year that you want to purchase the house, you may have to provide a year-to-date P&L. So again, those are some of the additional hoops that self-employed borrowers have to go through, but it's not that big of a deal. Is providing the documentation to the lender and let us get into if there is a problem. So why would there be a problem? Well, being self-employed, you have a lot of write-offs. And I think one of the misconceptions is, and we see it all the time, you can gross all this money. And in your head, you're making all this money. But from a lending standpoint, it's not about the gross income. It comes down to the net income when you're self-employed. And this is the pivotal, the number one difference between being self-employed and being a traditional, let's just call it wage earner. Now, if you know that you want to purchase a house and you're thoughtful about your tax write-offs, then you could talk to a lender and kind of get your plan in place. So when you get ready to file your most recent tax return, you're being thoughtful. I hear all the time, well, Kelly, gosh, if I don't write all that stuff, which I'm allowed to do, then I have to pay taxes on it. I know. I hear you. And this is why it is important to know that there are alternative home loan programs out there. And there are bank statement programs out there for self-employed borrowers. We talk with thousands of people, and a lot of times people just don't realize that you don't have to do this full income documentation process that I just explained. There are other options out there. Bank statement options are really helpful for self-employed people, especially wanting to purchase that second home. Now, there's a variety of different bank statement options. There's a variety of lenders out there that offer them. Some do, some don't. But typically, you're thinking about either 12 to 24 months bank statements. Those could be personal bank statements or business bank statements. Working with your lender, you'll be able to decide which program works best for you. But essentially what happens is over the course of either the 12 or 24 months, your deposits are going to be averaged, and then that would be your usable income. So that's kind of how bank statement programs work. Now, debt to income ratio, when we are working with our self-employed borrowers, a lot of times, depending on the type of business, there are a lot of vehicles involved, and many of those vehicles are paid through the business. Keep in mind that if the vehicle is in your name, your personal name, but paid through the business, there may be a way for that vehicle payment to be excluded from your debt to income ratio. 2 steps to this though. 1, you would have to provide the 12 months canceled checks showing that the business pays for the car. And if you're doing a full income documentation, self-employed home loan, then in addition to that, the lender will want to look to see if the car and truck expenses on your tax return include what you're paying through the business for the car or the truck. So kind of a 2-step process on the full income documentation strategy. On the bank statement strategy, obviously you're not providing the tax returns, so that piece of it would not come up. But the debt to income ratio itself is still fairly common, whether it is full income documentation or I'll call reduced income documentation or bank statements. Now, the difference in the loan strategy, though, is that you're going to pay very likely a higher interest rate when you're using a bank statement program because it's much more niche-y and it's not readily available like mainstream financing. So the terms of your loan may be different. But in having these conversations with self-employed borrowers, so like, look, I'd rather pay a higher interest rate and maybe a higher cost to obtain the loan and still get all my tax benefits of writing all these things off. So again, it's just one of those different conversation, right? It's just different strategy. But down payment and interest rate and terms will look different on bank statement programs for self-employed borrowers. Reserves, this is another thing that the lender or the program may require that you have a certain amount of reserves in the bank after closing. So they're going to look at your assets and they're going to subtract out whatever your down payment and closing costs are for the second home. And then whatever you have left over, this could be in your bank account, this could be retirement assets, this could be investment accounts. All of that counts as assets, but they may want to ensure that you have a number of months in assets post-closing, and that it would be after the down payment and closing cost on the new second home. Credit scores, generally we'll see a higher credit score requirement for a bank statement program. But if you're using a full income documentation program, the fact that you're self-employed, your credit score, as long as it's allowed by the loan program itself, you don't get a negative hit on, oh, I'm self-employed and I have a credit score of 680. It doesn't matter as long as you have the full income documentation strategy that you can meet the lending guidelines. The credit score is really not relevant in that scenario. However, over on the bank statement side, it is relevant. So higher credit scores if you have to use a bank statement program. And then lastly, there's so many different options. Again, we do work with a lot of self-employed borrowers. I would know that it takes longer for the lender to go through all of the documentation. So when we have that initial conversation, we're asking some details about, let's say you're a Schedule C self-employed borrower, meaning that you're a sole proprietor, and that's how you're filing your income on your tax return. In that initial conversation, we're asking you to look at line 31 of your Schedule C, and then we'll ask you about depreciation and a few things so we can kind of gauge, does it look like you're going to be able to use a full income documentation strategy, or do we need to move to a bank statement strategy? So some of those initial conversations are just helpful to give you a clear path on what you need to do. But let's say you're not quite sure or you don't have your tax return handy and you want to really have the lender get their eyes on it, which I recommend, then you would want to complete that pre-qualification application, let the lender pull your credit, and then provide the documentation to the lender. And they're going to review it and assess, okay, in this situation, maybe you can't qualify for the full income documentation loan, or maybe you can, but if you can't, then are you eligible for the bank statement program? So lots of different strategies out there for self-employed borrowers that want to purchase a second home.
Self-employment isn't the only situation where traditional income documentation can become a challenge. In fact, there are loan programs specifically designed around the property's cash flow instead of your personal income. In the next lesson, we'll explore how some investors are buying properties without using traditional income verification.
A lot of people miss this unique opportunity. It's truly an investment hack. So if you're in the market and you want to become an investor, or maybe you're already an investor and you're starting to push into the traditional mainstream loan guidelines, or you're just like, I don't want to jump through the hoops. I don't want to have to put forth all of my tax returns or W-2s or things like that. There is a loan out there, and that loan is called a DSCR loan. What does that stand for? Well, it stands for debt service coverage ratio. So it's a whole different approach to financing. This is for residential properties. It is for investment properties. And it could be used for Airbnb or short-term rentals as well. The difference on this is that this is a no income qualifying loan. The property and the projected rental income on that property is what qualifies for the loan. Yes, you have to have a credit score. Yes, credit score matters and drives the interest rate. Yes, you're going to have to put down 20 to 30%. All of that is yes, yes, yes. But the sticking point with so many people on wanting to acquire investment properties is really the income documentation, especially if you're self-employed. Because if you're self-employed, very likely your gross receipts versus your net receipts on that tax return are going to be materially different. So this solves that type of equation. It allows you to qualify based on what that property revenue is going to be. So let's walk through it. What does that really mean? What am I saying? Blah, 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 right? So let's say that the rental income is $2,000 a month. So the rental area and that projected rental income is going to be a factor on this loan. Let's say that the house payment itself is going to be $2,000 a month. And so that's house payment, HOA, solar if there is solar, property taxes, homeowners insurance, PITI, out the door, $2,000 a month. That's going to be a debt service coverage ratio of 1%, which means that the rental income on the property offsets the total payment on the property. So essentially it's a wash. That's a good thing. In that scenario, you can qualify. So let's start to look at where that starts to get off track. Let's say that the rental income is $2,000 a month, but the payment all in is $2,500 a month. Now you're in a negative debt service coverage ratio number. And it doesn't mean that you can't qualify. It just means that the strategy and the way we go about it, these loans have a lot of different moving pieces. So ideally, you're at that 1% ratio, but there are scenarios that allow for a no ratio calculation, that allow for, a higher ratio at 1.25. That could actually benefit your payment or your interest rate or the term. So lots of navigation here, but really at the end of the day, it's just important to know that this is a unique residential mortgage designed specifically for investors that want to acquire property. Maybe you're a small builder and you want to acquire property. You're going to do some type of renovation on it. Maybe you're an investor. You're just wanting to build wealth through real estate. This is the loan that allows you to do that without having to provide traditional income documentation. What are a couple of other things? One, you can close in an LLC, which is unique. So you can close in your own personal name, or again, close in an LLC. Lots of our investors want to close in LLCs for other reasons. So this loan will allow you to do that. There's no reserves generally, especially if you're doing a cash out refinance. So if you're doing a cash out refinance, it's important to know this isn't just for purchases. You can actually do a refinance with a debt service coverage ratio loan. The cash out in a cash out refinance, maybe you're wanting to liquidate, take some of the back out, go to buy another property. The cash out itself would cover the reserve requirement on the program. When I say reserves, when you're using a traditional, let's say Fannie Mae, Freddie Mac loan, and you're buying an investment property, the lender and the guidelines are going to want to see not just your down payment, not just your closing costs, but they're going to want to see a number of months of reserves for that property and potentially other properties you own. So if you think about it, if the payment on this property is $2,000 a month, and then you own 4 other properties at $2,000 a month, now you've got net payments of $8,000 a month. The lender may want to have a variety of reserves. Could be 2 months for your primary residence, could be 6 months for the property you're acquiring, could be 3 months for the other properties. In this scenario, it doesn't work that way. So again, we're falling out of traditional mainstream guidelines and we're getting into a program. It's truly an investor hack. It is designed for investors to build wealth. Traditional purchase scenario would like to see 3 months reserves post your down payment and closing costs. Generally for our investors, that's not a big deal. And it's on the subject property. But again, I do want to make sure that if you're an investor out there and you own property and you want to tap into some of that equity, this program works. I just talked about a whole lot of pros, right? Not having to produce tax returns, W-2s, and all that stuff. That's a pro. What are the cons? Well, the cons are this is a risk-based loan. It's a make sense loan. So the interest rates are going to be slightly higher than if you were to provide all the documentation and use a traditional conforming conventional loan that's being sold to Fannie Mae or Freddie Mac. So different strategy. So interest rates a little bit higher. The down payment is going to be more than what you would need on a conventional investment property. On a conventional conforming loan, you can do a 15% down payment. On the debt service coverage ratio loan, you would have to put a minimum of 20 to 25% down, maybe even 30% if you're wanting to get that interest rate lower. So it's more of a down payment asset-based type of scenario. Back on the conventional conforming traditional mainstream loan, again, that loan's going to want reserves. That loan's going to want an automated loan approval. That loan is going to require full personal income to qualify for the loan. The debt service coverage ratio loan doesn't, because again, the property's revenue that it's generating through the rental income is what is qualifying for the loan. It's pretty cool.
I hope this masterclass gave you a better understanding of second homes and investment properties and how they can fit into your long-term financial goals. Every situation is different, and the right strategy depends on your plans, your finances, and what you're hoping to accomplish with the property itself. If you're considering purchasing a second home or investment property and you want to explore your options, don't be afraid to call or text the Kelly Zitlow Group at 480-725-0150. We'll chat a little bit. We'll walk you through your goals, create a plan for you that works. And if you found this video helpful, please be sure to subscribe to the Mortgage How Do I channel so you don't miss future mortgage tips, strategies, and answers to your biggest home financing questions. Thanks for watching, and I'll see you in the next masterclass.